So for chapter 9, we're going to talk about assets and how to do depreciation. So in the first example, I have a Volkswagen Bug, a Beetle, and I have some the cost for this car. And then we also spent money on a paint job, to buy tires, to pay tax for when we initially bought the car, registration, we tinted the windows, we also have a mechanic check the engine before we buy it, and every month we have a gas bill. So what we want to find out is, what of these costs do I include for the cost of my asset? So the rule is stated that we can include all the costs to get the asset to its intended purpose, to get it to how we want it to be on day one. Once we start using the machine, any costs thereafter that we incur would be expenses. So for this car, we want to think about, what can I count? What is the value of this car? What's the asset value? So actually all of these things to get the car how I want it to be, including the tax and the registration, they can all be included in the cost of this car. So my cost is going to be the sum of all these. I'm not including the gas that we spend every month to use the car. Now, this is my cost. When we do depreciation, we want to use the depreciation cost, the depreciable cost. So I need to minus my salvage value. In this example, we're going to have the salvage value be $210,000 to make it easier. So salvage value is also known as residual value. It's the amount that we can get for the car when we want to sell the car. And it's like our throwaway value. When we're done with the asset, you'll have some scrap value. Okay. So when we're done with this car, we no longer want to use it. We think we'll be able to sell it for this amount, $210,000. Okay. So I'm actually, the currency I'm doing is in baht, not dollar. Okay. So it's in Thai baht. So my depreciation, my depreciable cost I want to work with when I do my calculations, I want to do the total cost of the asset to get it to how I want it to be, minus that salvage value, residual value. So 3.5 million Thai baht. Okay. Now we have three methods. We have the straight line method, units of production method, and we have the double declining balance method. The simplest is the straight line method. The more complicated advanced would be the double declining balance method. So let's go ahead and start with the straight line method. The straight line method is going to use this amount, and you need one other amount. You need to know how many years you'll use the asset for. Okay. So let's assume we'll use this car for 10 years. So I would take the total depreciation cost divided by 10. And that's the per year amount I depreciate out. So over here is my straight line method. For each year, this is my depreciational amount, $350,000. So again, I just took the total depreciation cost amount, and then I would divide it by the amount of years. And in this example, I used 10 years. If I wanted it to be 5 years, okay, if I think I'm only use this car for 5 years, then I'll get rid of it for the $210,000. Then I would need to get rid of those. Okay, so I would then take the depreciation cost divided by 5. Okay. Oh. So this would be my new value. and I'll take this exact same amount every year. So straight line will always be the same amount every year. Okay. The second method, the units of production method. So again, I'm going to use this 3.5 million. Instead of dividing it by years, I want to divide it by how many units I think I can get out of the machine or asset. So maybe for a car, we're going to assume, oh, this car is good for 200,000 kilometers, okay, 200,000 km. So instead of putting the life of the machine in years, I'm putting the life of the machine in units. So what I need to know now is the per unit depreciation cost of this machine. So I want to take the 3.5 million, and then I want to divide it by the 200,000 kilometers, and I'll get the 17.5 per kilometer. So I'm taking the total cost minus the residual salvage value. I'm getting the depreciation cost, and then I'm dividing that by how many units I can get out of the asset. So I'm assuming we'll drive this thing for 200,000 kilometers, and then we won't want to use it anymore. It's too old and used up. We want to get rid of it. So I'm just dividing those two numbers. And the 17.5, what that means is every 1 kilometer I drive my car, it loses 17.5 baht in value. Okay? So it's a per unit. Now, for my units of production, I need to know how many years we use it. So year 1, year 2, year 3, year 4, year 5, 6, and 7. So these add up to my 200,000 kilometers that I'm saying I'll use the machine for. And what I'm going to do is I'm just going to take the 17.5 times however much I used it. Okay. So if I drove 200,000 kilometers in the first year, then I would take the whole 3.5 million out that first year. Okay. So these are the dollar amounts that I'm taking out in these years. Okay, year 1 through 7. These all add up to the 3.5. Okay. So I know I did it right. And these will all add up to the 200,000 when I'm done with it. Okay. And we're not in dollars. Okay. So those are the two simpler methods. So I would use straight line if I thought my machine's life was in years, and I would use units of production if I thought my machine's life was going to be in units. Like a machine that can do X amount of units, and then it's not good anymore. Like a car. Okay. A building or something we might want to do, a building is good for so many years. And then finally our third method, double declining balance method. Okay. So the double declining balance method, we need to use this formula. With this method, I don't care about the 3.5 million anymore. I'm going to start with the total cost, the 3.71. That's my book value of the car. Okay. I'm going to use this formula. So I'm going to do cost minus accumulated depreciation. So cumulative depreciation, the number will get bigger every year. It's like a snowball effect. It's accumulating. So we're using up we're adding to it our current year plus all the previous years. And then we're going to times it by 2 times the life. So in this example, I have my life is 10 years. And so every time I compute this formula, I'll use 10. I'll do 2 divided by 10. Okay. I won't change it. I won't do 10 and then 9 and then 8 as the machine gets older. So here's my formula. For year 1, my depreciation expense is my cost, 3.71, The first year, my accumulated depreciation is 0. We have nothing to minus. So it's minus 0, and then times 2 divided by 10. So my depreciation expense will be $742,000. I'll go ahead and minus that from the book value. So I keep a running total of book value here. Okay, now year 2, I'm going to take cost minus my total depreciations so far, which is 742, and then times 2 divided by 10. Year 3, total cost minus, I need to take my depreciation expense from year 2 and year 1, subtract them both out. Year 4, skip down. So year 9, I'm taking the book value of my car, minusing all my depreciation expenses I've accumulated, okay, times 2 divided by life, 10. Okay. And so my book value in year 9 is $497,948. Now, the trick is, in the last year, I no longer use my double declining depreciation formula. I abandoned that formula, and I'm going to use a plug-in value. I'm going to make this number up so that the final year of this machine, my book value will be my salvage value. It's going to equal my salvage or my residual value. The salvage or residual value. Oh, can't do equals. Okay. So that 210 is what we had said earlier in our other 2 examples. So this number, I'm going to do this minus that to get this. So this is what my depreciation expense needs to be in year 10, so that my final book value at the end of year 10 will be my salvage residual value. Okay. So those are the 3 methods for depreciating out an asset. Now we have 3 types of assets. Just want to talk about those real quick. So we have assets that require depreciation, depletion, and amortization. So depreciation, these are physical things like a computer, a car, a machine, a building. They're man-made, tangible, you can touch it. Okay. Depletion, this is Mother Nature. This is like a gold mine, an oil field, a forest of trees. So if I have a lumber industry, I'm chopping down trees, selling trees. Every time I chop down a tree, my forest loses value. Okay? Or every time I take gold out of the mountain loses value. So that would be depletion. So it's used in the same sense as depreciation, but just for a different type of asset. And then amortization, again, is used in the same sense, okay? But it's for man-made things that are intangible. We can't touch them. Things like a copyright or a patent. So there are some legal contract paperwork that have value. So let's look at how we can do some journal entries. So for my buying my iPhone patent, we'll debit patent and then credit cash. So that's us buying the patent from Apple. Okay. And then, so a patent is only good for so many years, maybe 10 years or 50 years. Okay. So every year I need to decrease the value of my patent. So I'll probably use a straight line method. Okay. And I'll do an amortization expense debit and then devalue my patent. And then for depletion, so I'll do a depletion expense and then accumulated depletion. Depreciation works the same way. I do a depreciation expense debit and credit accumulated depreciation. Okay. So that's chapter 9. If you have any questions, feel free to leave any comments. Thank you.